Hello, and welcome to Portfolio Matters, Week 10 Weekly Update. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end.
Thank you, Richard. Okay, so big news again this week. So Biden has got his stimulus plan through the Senate and through Congress. So this is going to happen, and it is big. So US GDP is 21 trillion, and the stimulus is 1.9 trillion. So, 9% of GDP. It's enormous. And if we look at the history of COVID stimulus plans, it's the latest in a long line of enormous plans. We had 2 trillion in March 2020, a further 900 billion in December, and now 1.9 trillion. So this obviously was proposed in January, but will go live in March.
So we're looking at 30% of GDP in total, aren't we, Keith? It's enormous.
Yeah, absolutely enormous. And in comparison, all the stimulus plans after the financial crisis added up to 800 billion, that should be, not trillion. We get so used to throwing billions and trillions around that I'm getting quite confused. So we maintain that we think inflation is coming with all this stimulus. Also, the ECB has announced that it was going to increase asset purchases to suppress rising bond yields. So we're seeing all around the world both simultaneous fiscal and monetary stimulus. So details of the Biden stimulus plan: $1,400 per household and $300 a week in unemployment supplement extended to September. So this is going to working families who will spend it. It's not going to the rich who are going to save it. Now, the other thing that caught our attention this week and has got some slightly hysterical commentary online is the supplementary leverage ratio for US banks is expiring on the 31st of March. Now, what this does is during the COVID crisis, the leverage ratio was suspended. So they allowed the US banks not to include deposits and US bonds, US government bonds, in their as part of their liabilities. So if they then unwind this, the US banks will have a problem and they'll be over leveraged, and they will have to probably either sell US treasuries or they won't be able to buy any more. And obviously, when the US is issuing a vast amount of debt as part of its stimulus plan, that is a problem. Now, they have to find a way around this, which I'm sure they probably will do. Richard?
Yeah, I would imagine. I mean, they're going to take the pragmatic approach, aren't they, Keith, and extend a supplementary leverage ratio exemption for 6 months or whatever it will be. And given where we currently are with the vast amount of treasuries that are having to be issued, you suspect ultimately it will become a permanent exemption of some sort. And one of the issues is when governments issue so much debt, they have to start forcing people to buy it if they don't want to buy it themselves. And I suspect this is maybe a first step down that route of increasing the pressure on financial entities to buy US treasuries.
Yeah. Now, the downside of allowing this supplementary ratio to be extended is that apparently it really favors large US banks versus smaller ones. And also, obviously, they're no longer in accord with the Basel III agreement. But as you say, they will. I'm sure they'll be pragmatic. So I don't buy the slightly hysterical end of the world stories. The other big news of the week is a big bounce in Tesla and the Nasdaq. Everything seems a bit oversold and it's bounced back hard. But I liked the commentary that stated that this was the signal going along the Brontosaurus, and so the tail knew that the end was nigh, but the head hadn't quite worked it out yet. And I think that is right. So this is a reflexive bounce in Tesla, but I am deeply skeptical it can be maintained as bond yields rise. Now, the other thing I wanted to talk about was an article by John Dizard in the FT, and I really like John Dizard. I think he always talks about interesting things that you don't hear anywhere else. And he was describing the current spike in commodity prices as a function of the supply chain. So the beer distribution game is something they play in business schools. And the idea is that one person plays the brewery, one person plays the distributor, and one person plays the bar. And the idea is you have to get the supply chain working so the bar always has enough stock for its customers. Then one day somebody comes in and the bar has a 20% uplift in its demand. And so it orders not just replacement stock, but additional stock, because it is uncertain over whether this increase in demand will be permanent. And so instead of ordering an extra 20% demand, it orders 30% just to be safe. Now, when the distribution center has exactly the same problem, and it sees a 30% increased demand, and it makes a 40% increase in its order to the brewery. So the demand signals at the front end have led to an exaggerated supply signal at the back end. And so what appears to be he's saying is happening is that the increase in demand is leading to a lot of inventory stocking. And this is likely to be temporary. So anyway, something to watch.
I suspect he may well be right, Keith. I think that probably we have some multiple factors here, don't we? One of which could well be this. One of which would have been sort of natural destocking that probably occurred during the worst of the lockdowns and so forth. But we also know that demand for certain metals, copper and rare earth, for example, is going up very dramatically, or certain rare earths. So I'm less certain as to why agricultural commodities are going up, because I'm not aware that total agricultural production is changing significantly. But I'm no expert, so I think it's probably very complicated.
No, absolutely. But this is something where I think we should just be aware that the commodity spike may be a temporary phenomenon, and this is something to watch rather than to be too predictive about.
Or we may be in the process of a significant uptrend where we've just got ahead of ourselves and it's going to pull back.
Yeah. Okay, so moving on, the Fed is still printing. So currently, we have both monetary and fiscal stimulus. The fiscal stimulus in the US is going to be enormous, but the Fed's still printing. And, inflation. So this is contemporaneous measures of price increases, which are the light blue line, and core CPI. And as you can see, there's this 6-month lag. So what it's saying is inflation is already here. It just hasn't been measured yet. And US households already have a lot of cash. Now, this chart is basically saying that there's cash that is not in the markets. And if that cash should be committed to the markets, there's a lot more upside to come. But all we can say is there's a lot of cash sitting on the sideline.
Yeah.
And I think there's a lot of it's already come into the market. I mean, this is a chart showing that retail trading now accounts for as much volume in the US market as mutual funds and hedge funds combined, which is absolutely amazing. And you can see that that trend is a recent one, 2020 and 2021, people stuck at home with money playing the markets. Now, the chart top left shows changes in US growth expectations compared to the rest of the world since the start of the year. And what it's saying is growth expectations for much of the rest of the world have actually been downgraded. But growth expectations for the US, presumably in part at least because of the massive stimulus, have been upgraded. And that matters because that's going to feed through to rising US interest rates. And those interest rates will be exported around the world. So all interest rates are linked. So if the US raises interest rates, then bond yields around the world start to rise. Richard?
Yeah, so this is one of my favorite websites. It doesn't update that often, but this is the total small business revenue in the US. And you can see that not only has it not recovered from after the sort of initial lockdowns in June, it seems to be on a gently sloping downward trend, total small business revenue. And this is really, really bad news for the US economy. I suspect it's replicated throughout the developed economies. And what it means is that when we sort of get back to normal after the vaccination programs are completed and we have some sort of reasonable degree of immunity, it means that there's going to be whole swathes of the economy that are in a dire situation. And at the moment, I think this is hidden. You can't see it because of the lockdowns and the restrictions. And if you move on to the next slide, Keith.
Well, hang on. Before we move on, Richard, I mean, what's interesting is they have put on here the times when stimulus checks hit the economy.
Yeah.
And there do seem to be, spikes up the moment stimulus checks hit. So, that is possibly good news. There's an enormous stimulus check hitting. You can see a spike up.
Possibly. I mean, I think the April the 15th stimulus, it's fair to say what initiated that spike up, isn't it? Because the first lockdowns were coming to an end. The January, the second stimulus didn't seem to make a great deal of difference. There was a short spike up. And as you say, we may get a spike up now. But I think the point, Keith, is that a lot of these businesses, I think, have been annihilated. They don't exist anymore. And the small businesses open, with 35, 40% down. And how long can a small business stay shut before it never reopens? So I think if we go back to this sort of vast stimulus that's coming out, what is it going to stimulate? I think it's really, really unclear how that is all going to pan out, because there's such a sort of huge discontinuity in the economy, or multiple discontinuities.
Yes, well, something to watch. We'll rely on you to keep us updated, Richard.
Thank you. I'll do my best. So this is my favourite chart. This is a long-term chart of the US 10-year yield, and Keith is rightly pointing out that yields are going up. My contention is that these yields have been within this parallel trend, within this trend for 30 years, and why would it change? And if it doesn't change and the past is foretaste of the future, in 2022 we're going to be heading towards negative yields. And I don't think that is an unlikely outcome given the vast quantities of debt that governments have on their books and are going to be taking out, and the simple unaffordability, particularly as they roll debt over. So, I think there are two arguments which move in opposite directions, and I don't think that we know what the outcome will be.
Well, I completely agree with that, Richard. I think there's a vast amount of debt and there are strong deflationary forces. I personally think that all the monetary and fiscal stimulus will send inflation shooting up, but that may well be a temporary spike because high interest rates would then kill the economy. So, frankly, I don't want to be too doctrinaire. I prefer to be nimble and see how we go. And I'm well aware of this chart. Thank you. And I think it's again something we just need to keep on watching. Okay, so on to the checklist. Well, it was a great week in the markets. FTSE was up best part of 2%, and that was a great performance, but it underperformed everyone else who had a strong bounce. So the Nasdaq was up an amazing 5%, bouncing back from its recent lows. S&P was up 4.4. Topics, the Japanese index, up 3. Bitcoin had an amazing week, 21%, and Richard will be talking about that. Sterling was up. Okay, and moving on to the industrial commodities. You'll see that I've added ferrovanadium after our discussion of vanadium and Bushveld minerals this week. Now, the big ones are iron ore is down 5.3%. Copper bounced back. So, last week it was down from its highs. Well, it's heading back towards them. And the big one is lithium, which I will leave Richard to discuss on his weekly. Precious metals were stabilized up slightly. Platinum had a good week. Rhodium, which has had an absolutely amazing run, was down from its highs, but frankly, that it's done this before as well. So these whenever a market goes parabolic, it tends to be a draw pullback, but the trend, frankly, is very much still intact. So one to watch. Base rates kind of flattish, but drifting up, and the drift up is big spike this morning. So
there was,
I still think.
I noticed that yesterday Rishi Sunak, the UK Chancellor, was in front of a parliamentary committee, and he said one of his greatest fears was a rise in interest rates. And it rather looks as if the market has taken that as meaning interest rates will rise, and clearly. As we've discussed, any increase in interest rates causes very significant problems for government borrowing, and for the economy, and for the housing market, and for indebted consumers, and is just bad news under the current circumstances.
Yeah, no, absolutely. And that market's like finding your pain point. So, eventually, I fear a strong rise in interest rates, which will force governments to actually react in some way.
Yeah.
And the seasonality chart, well, bang on cue. The Nasdaq, all the equity markets have had their second week of March rise. Anyway,
well
we'll leave that out there, I think. Right. Okay. So, Richard, do you want to go through your weekly activity?
Thank you, Keith. Thank you for that run through, Keith. So my weekly activity this week, my portfolio was up 1.4%, down 1.7% for the year. Purchases. So I suffered immediate regret after exiting my crypto coin positions. So I bought a third of them back, realizing that my desire to get out was because my position was too large for me and it was causing me too much anxiety. So with a third of my original position, of my position I sold, I feel much more comfortable. I'm just going to sit here with that. And as you know, I am a cryptocurrency bull, and I want to be able to reflect that in my positioning, but I don't want to be uncomfortable. I also bought Colonial Coal. Now, we did a presentation on Colonial Coal, and we had some comments back about that you can refer to from people who knew the company very well. And on reflection, I decided that it would be a good idea to buy some of this company. Rambler Metals was introduced to us by Keith, copper and silver. I sold my holding of Altisource Portfolio Solutions. So this is a US company that facilitates the processing of borrowers who are in default for lenders. And the rationale for buying it was that a lot of US mortgagees were likely to go into default. The rationale for selling it is that this is being prevented by the government. And until the government stops preventing it, there will not be a spike in the revenue of outsourced portfolio solutions significantly enough to raise the share price. So they also had results out yesterday evening or yesterday evening UK time, and I noticed that the share price didn't really move on the results. So I will continue to monitor it, but I'm not going to be back in it until I see signs of the US government moving away from protecting people from mortgage default. And I think that's a very difficult thing for them to do from a socio-economic point of view. So we shall see.
Yeah, well, I have retained mine, Richard. So I'm a big believer that eventually the markets are going to be allowed to normalize. Right now, I'm not looking terribly clever, but I'm committed.
Yeah,
but I admire your moving in and out of trades. I think that's very good.
So as Keith referred to in our weekly update, the price of lithium went up extraordinarily this week, and by 20%. So obviously this is to do with enthusiasm for batteries, but I didn't see any particular news item that caused it to go up. I don't know if there was something that specifically created an impetus there. And then, as before, looking at my holding of Zinnwald, which is the German nascent lithium producer, it's gone up a little bit, but it hasn't gone up in a manner that one would have hoped it would have gone up to reflect the increase in lithium price. So yeah. I'm still in there. It's still on an uptrend, and it's interesting to see how it doesn't really bounce around in the same way as the lithium price does. So. Cryptocurrencies, Bitcoin is back to its all-time highs. I missed it a little bit by being out and then back in, but as I say, I'm comfortable with that. And Ethereum is nearly back to its all-time highs, and we shall watch this space. As you know, I like to keep an eye on silver. Silver price is still within this range, and my quick reality check on the Bullion by Post website indicates that all the silver bars are currently in stock, so no shortage of larger quantities of silver.
Actually, Richard, that's not true. The bottom three are waiting stock.
Yes, but they're tiny. I think they're tiny little specialist ones, Keith. Okay. 2.5, 5, and 10 grams.
Right, got you. Thank you, Richard. So I had a good week. I was up 1.3%, which takes me to 5.7% year to date. I had quite a quiet week. The only share I sold was Invinity Energy Systems, which is a vanadium redox flow battery producer. And essentially, we did a share talk on vanadium, and also this is a growth story with very little revenues currently. And as interest rates rise, it's just about the sort of company that I expect to suffer. So the share price had drifted down and I took my losses. However, that's not really what I want to talk about with Invinity. I hold my shares with a large broking firm, which will remain nameless for now. And when I went to sell my shares, I discovered I was missing 2,050 of them, which is worth about $3,000. Now, these nominee accounts, the way they work is that the stockbroker has a single position in this company. and then it allocates those shares amongst its clients. And as you buy and sell them, you are relying on the broker to keep track of your allocation. Now, in this case, I have a very good record of all my trades in this company. And what seems to have confused them is I took part in a share placing, and my holding seems to have gone awry after that share placing. So as of now, I've sold the shares that I've allocated, but I am missing £3,000 worth of shares that I should have. Now, this is ongoing, and we will see what happens. But this is the first time shares have gone missing from my nominee account. So I'll be interested to see how this is handled. And this is Infinity. So I bought it earlier in the year in a fit of enthusiasm for new energy. And I only bought 2 stocks this week. I bought Jadestone Energy, which is a oil exploration company with some very experienced management, and they're essentially scavengers buying old mature fields in Southeast Asia and attempting to increase their production, and I believe in the management. And also Barclays. So I bought all the UK banks, and I was in conversation with friends, and they said in their experience Barclays was the most dynamic, and the staff were the ones who seemed to be most on the ball, and they were very down on Lloyd's. So anyway, I've increased my holding in Barclays. And that is it. Oh, no, one more thing. Tecmar, our favorite stock, has won another contract, this time for subsea innovation. But, it's not doing the share price much good. The share price has drifted off. But anyway.
I suspect.
So I think that's it for this week. Richard, you got anything else?
No, Keith, I was just going to say, I suspect that there's been a bit of froth in the sort of clean energy market, generally speaking, and I suspect that the buyers have bought, and that things might well drift sideways for quite a while now.
Yeah.
So, but no, we're a relatively quiet week, Keith, and obviously a quiet week for you.
Absolutely. Okay, well, thank you all for watching. Please, can you subscribe to the channel and press like, and watch some of our other videos, more of which are coming up today. So in the meantime, it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan.
Goodbye.
Goodbye. Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only, and should not be relied upon for making a business, legal, or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website, or to any information, products, services, or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.